The warning hit Wall Street before sunrise. The biggest United States banks had quietly abandoned Scott Bessent's $20 billion lifeline for Argentina, leaving a hole so large Treasury officials stopped pretending it could be patched. By mid-morning, another shock detonated. Nvidia's forecast for China didn't just fall, it collapsed to zero, a number so severe it wiped billions off future revenue models in a single breath. Two pillars of American power, finance and technology, slipping at the same moment for reasons no one in Washington can fully control. The tension escalated when Bloomberg detailed how the original two-pillar structure depended on synchronized moves, a $20 billion Treasury swap line, and a $20 billion private sector lending arm. With the banks pulling back, the entire weight of the operation fell on the United States government, turning what began as a market-aligned program into something that looked dangerously political. One senior trader told Reuters the imbalance made the package unhedgeable, a word rarely used for sovereign support deals. The immediate consequence landed on farmers before it reached investors. During the previous trade war, USDA export data showed China slashed purchases of United States soybeans while Argentina expanded shipments. Many American growers now argue that a bailout for Argentina strengthens a competitor that diverted Chinese demand away from them. Their grievance is specific. The United States government appears ready to underwrite a country that benefited from their earlier losses. Inside Washington, the timing triggered suspicion. Support discussions accelerated right before Argentina's midterm elections. FT reporting mentioned that critics viewed the move as favorable to Javier Milei, a Trump-aligned libertarian reformer whose political future is tied to economic stabilization. Bessent publicly rejected that interpretation, telling the Wall Street Journal the Exchange Stabilization Fund had a strong record of protecting U.S. assets and that the goal was to secure a reliable partner in a strategically critical region. The strategic reasoning emerged more clearly in background briefings. China has expanded yuan-based financing across Latin America, and Reuters reported Argentina renewed a multi-billion yuan swap line earlier this year to stabilize reserves. That facility allowed Buenos Aires to pay for imports and manage obligations without drawing on dollars. The shift concerns Washington because dollar dominance relies on global demand for United States currency in trade and reserves. A growing yuan footprint in South America diminishes that leverage. One synthesis connects these moves. The bailout is not merely financial support, but a defensive maneuver against currency realignment. If Argentina normalizes transactions in yuan, the region's financial architecture tilts toward Beijing, making United States influence harder to assert through market channels. But the bank's refusal reshaped everything. JP Morgan, Citi, and Bank of America reportedly demanded strong collateral guarantees before committing tens of billions. Without an explicit United States backstop, they viewed the risk as disproportionate. The shift to a $5 billion repo wasn't a soft landing. It was a structural downgrade that signaled distrust in Argentina's short-term solvency and Washington's political cover. A consequence emerged quickly. Emerging market funds began reassessing exposure not just to Argentina, but to other countries dependent on dollar liquidity. One portfolio manager told Bloomberg that the decision signals where Washington draws the line, suggesting dollar diplomacy may be tightening even as geopolitical competition accelerates. The macro tension widened during the same week Nvidia faced a revenue threat on the other side of the world. CEO Jensen Huang warned in a public appearance that China sales for upcoming quarters could drop to zero under United States export restrictions. He emphasized China's AI chip market, estimated at $50 billion today and potentially reaching between $150 billion and $200 billion later this decade, was too large for American companies to exit without consequences. His remarks, carried by multiple outlets, forced investors to confront a scenario they had avoided pricing. Nvidia losing access to the fastest-growing AI hardware market on Earth. The implications ripple into national security. Washington's restrictions aim to limit China's access to cutting-edge data center GPUs. But Beijing has responded with accelerated domestic investment. Chinese state media and university researchers have claimed breakthroughs in alternative chip architectures designed to reduce reliance on Nvidia's technology. One research group asserted that a new analog computing design could achieve several orders of magnitude higher throughput than conventional digital GPUs by performing calculations inside memory rather than moving data across separate pathways. These claims have not been independently verified by major Western outlets, and no global semiconductor authority has confirmed comparable accuracy at commercial scale. Still, the assertions alone shift expectations. If China even partially succeeds in building competitive domestic AI hardware, Nvidia's leverage evaporates. The company's valuation exploded past $5 trillion on the assumption of global dominance. A sudden zeroing of its China business, combined with the possibility of parallel Chinese innovation, creates a contradiction. The world's most valuable chip company now faces its most constrained market access since its founding. A broader pattern becomes visible. Financial and technological power are colliding across hemispheres. In South America, China provides fast liquidity in Yuan. In Asia, it expands domestic chip development. In the United States, banks step back from a politically sensitive bailout while tech markets depend on valuations built on uninterrupted global demand. Another synthesis clarifies the stakes. The United States cannot sustain simultaneous financial retrenchment and technological decoupling without exposing vulnerabilities in both domains. Each system relies on the other to maintain international influence. The human consequences surface in unexpected ways. Argentine workers face inflation that Reuters recently described as one of the highest among major economies. Farmers in Iowa are watching futures markets for signals that Chinese contracts may shift permanently toward Brazilian or Argentine suppliers. Software developers from Seattle to Singapore rely on Nvidia hardware for training models, and any disruption pushes cloud computing prices upward. The United States government now stands between two forces. On one side is the geopolitical imperative to maintain dollar primacy. On the other is the economic imperative to keep core technology companies fully global. When Bessent defends the bailout, he frames it as preventing regional drift toward Beijing. When Huang warns of lost market share, he frames it as preventing technological drift toward Chinese alternatives. Both tensions originate from the same expanding sphere of Chinese influence. What complicates the situation is that China's own ambitions are not declared through formal doctrine but through incremental mechanisms. Yuan swap lines here, AI funding there. Semiconductor subsidies through provincial governments. Reuters recently estimated China's industrial policy spending at levels far above earlier projections, though precise totals remain opaque. If Argentina deepens Yuan transactions, Washington loses a key regional anchor. If Nvidia loses China, American AI leadership becomes more fragile. If United States banks refuse large-scale sovereign risk, America's financial statecraft loses elasticity. Each domain carries its own internal contradiction. Protect influence by pulling back, or protect influence by extending commitments. Meanwhile, financial markets are beginning to act as if the contradictions are already breaking. The S&P 500's price-to-earnings ratio, according to Bloomberg market data, has drifted above historical trends, driven largely by AI-linked expectations. Fund manager surveys show an overwhelming majority viewing U.S. markets as overvalued. Even Goldman Sachs leadership, quoted by Axios and the Financial Times over recent months, warned of echoes of the dot-com pattern. High valuations justified by future earnings that may not materialize if global access tightens. Inside Washington, the political calculus is tightening. Supporters of the bailout insist that the alternative, ceding influence to China in the Western Hemisphere, would cost far more in the long run. Critics argue the U.S. cannot afford to underwrite foreign governments while domestic sectors face rising costs from export controls. The question becomes whether strategic influence should outweigh economic caution. On the technological front, Nvidia faces a mirror dilemma: maintain compliance with U.S. restrictions and lose access to China, or push for regulatory adjustments and risk political backlash. Huang signaled the company would assume zero revenue from China for upcoming quarters, a shift that Wall Street Journal analysts interpreted as an effort to manage expectations ahead of potential downside revisions. These parallel pressures create a narrative where financial statecraft and technological dominance intertwine. The U.S. needs banks willing to deploy capital abroad to maintain influence. American tech companies need global markets to maintain scale. If both channels constrict simultaneously, the world begins rewriting the assumptions that powered U.S. leadership for decades. As for China's alleged analog chip breakthrough, experts in the semiconductor industry caution that claims of thousand-fold improvements require extensive third-party validation. Engineers speaking to the New York Times in earlier coverage noted that analog processing faces scaling challenges and manufacturing constraints that have historically prevented it from replacing digital architectures in general-purpose AI workloads. Yet the fact that Chinese institutions are asserting such advances suggests an ambition to leapfrog rather than merely catch up. Every claim, verified or not, becomes part of the geopolitical signaling. In the bond market, Argentina's shrinking rescue package has already led to wider spreads. If the repo fails to stabilize reserves, the IMF may be forced to revisit its existing programs. That possibility introduces a new unknown: whether China would accelerate yuan financing if Western institutions step back further. Financial hesitation at the core of the United States system is unfolding at the same moment China is expanding its influence through liquidity and technology. That alignment raises the stakes of every decision Washington makes, because each retreat creates space for Beijing to advance. Toward the end of the trading day, an unusual data point surfaced. According to a Wall Street Journal analysis, a rising share of global reserve managers have begun holding more diversified currency portfolios to hedge geopolitical risk. The shift is still small, but it signals a quiet recalibration, and that leads to the question hovering over both crises. If United States banks refuse sovereign risk, and United States technology companies lose access to key markets, the pressure does not fall on Argentina or Nvidia first. It falls on the dollar itself, because the currency's power is built on the world's willingness to rely on American finance and American technology at the same time. The next break may not come from a missed bond payment or a downgraded earnings projection. It may come from a central bank deciding the safest hedge is distance. Which pressure point hits first is no longer a theoretical debate. The data suggests the decision is already underway. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.